Hello, everyone. I need you to stop what you're doing for a second because something just happened in the silver market that most people will not understand until it's too late. In the last few weeks, nearly 100 million ounces of silver have been stood for delivery on the major futures exchange. Not traded, not rolled, not paper shuffled, delivered, claimed, removed. And when metal gets pulled out of the paper system at that kind of speed, it's not an ordinary trade anymore. It's a message. So in this video, I want to break down exactly what happened, why it matters, who could be behind it, and what it might mean for small silver investors who do not have a seat at the big table. We're going to talk about the delivery numbers, the quiet policy moves that change the rules of the game, the tug of war between industrial demand and financial demand, and why the dollar's strength might be the biggest optical illusion in modern finance. And then, once we connect the dots, I'm going to show you the one pressure point that could force a repricing event that headlines can't ignore. Because if you think the story ends with a few large deliveries, wait until you see what happens when the real-world buyers collide with the paper promises. Now, quick note before we dive in. My YouTube stats show that a huge percentage of you watch these videos, but you're not subscribed. If you value this kind of straight talk, hit subscribe right now and comment OG John AG to show you are supporting original creators and not the copycats. Also, if you want daily updates, quick posts, and my personal analysis that I don't always share on YouTube, I've created a WhatsApp channel and community where I drop premium notes, instant voice updates, and fast breakdowns when something moves. The link is in the description. Join it so you're not reacting late. All right, let's jump in. Here's the first thing you need to understand. Most people think silver is a price chart. Up one day, down the next, maybe a little hype, maybe a little fear. But the real silver market isn't the chart. The real market is the flow of physical ounces from the hands of sellers to the hands of buyers. And the moment the biggest buyers start demanding delivery instead of playing the paper game, the entire illusion gets stressed because the future system only works smoothly as long as most contracts never end in delivery. They get rolled forward, closed out, netted, offset. That's normal, that's the engine. But when people show up and say, "No, I don't want the paper, I want the metal," it's like walking into a bank and asking for a mountain of cash while everyone else is still swiping plastic. That's why the best comparison isn't a normal market. It's a redemption event. It's like a fund that promises daily liquidity while holding illiquid assets. It's fine while everyone is calm. But when people rush to redeem, you find out what's real and what's just accounting. And that's why the analogy to a famous fraud works so well. Everyone was happy while the checks kept coming until they asked for the principal back. Then the whole thing had to reveal itself. The silver market has a similar vulnerability. It can manage paper flows, but physical flows are a different animal. So why now? Why is this happening now? Here's where things get even more interesting. Because this delivery behavior isn't coming out of nowhere. It's happening alongside a series of policy and supply chain shifts that quietly change the landscape. For example, silver has been flagged as a critical material. Not because it's shiny, not because it's a collector's item, because it's essential. Essential for electronics, essential for solar, essential for military systems, essential for the industrial backbone that modern nations can't function without. And once a material is labeled critical, it stops being viewed as a commodity and starts being treated as a strategic input. That's a different mindset. That's the mindset where governments start thinking in stockpiles, domestic needs, and supply security. And while the public debates whether silver is too volatile, the big players are asking a different question. Can we secure what we need before everyone else does? Now, layer on top of that the reality that a massive share of global silver refining capacity sits in a small number of hands. When the major refiners tighten export rules or prioritize domestic needs, the global supply people talk about becomes less global very quickly. And here's the part people don't like to admit. When a country refines a huge portion of the world's silver, they don't need to ban you from buying it. They just need to slow down the faucet. A small policy change can create a large downstream shortage. So when you see massive delivery demands on an exchange, at the same time, policy signals are shifting toward prioritizing domestic needs. That's not random. That's a pattern. It suggests the big buyers are positioning for a future where available silver is not the same thing as silver that exists somewhere in the world. Because silver that is in a vault in one country is not the same thing as silver that's accessible to global industry. Now let's talk about the scale, because people hear 100 million ounces and it feels abstract. Let's make it physical. A monster box of popular coins is heavy. Multiply that by thousands. Multiply that by tens of thousands. You're talking about logistics, security, warehousing, and strategic planning. Nobody does that casually. And that's why the next question is the one we have to ask, even if it makes people uncomfortable. Is a government involved? I'm not telling you it is. I'm telling you the behavior matches what you'd expect if a government was quietly building or replenishing a strategic stockpile. And before someone says, why would they do it in the open market? Remember, standing for delivery is legal. It's how the system is designed. If you have the capital and you want the metal, you can do it. And if you're a government agency or a connected institution, you might prefer to do it through mechanisms that look normal on paper, even if the scale is extraordinary. And the numbers we're seeing are not normal. One recent month saw close to 70 million ounces stood for delivery. Then, in a non-major delivery month, the market still saw tens of millions more within days, within a week, which is the part that should make your eyebrows go up, because minor months are supposed to be quiet. They're supposed to be the months when the system breathes. Instead, it's acting like someone is pulling oxygen out of the room. Now, who is doing this? That's the question that turns this from interesting into dangerous, because retail stackers, even when they're motivated, don't show up and stand for delivery of 38 million ounces in a week. That's not a couple of guys buying tubes of Eagles. That's not even a big coin dealer restocking inventory. That's a scale that belongs to institutions, governments, mega industrials, or all of them working in parallel. And when you ask who would want that much silver right now and why, the list gets short and uncomfortable. Maybe it's a government. Maybe it's an industrial giant. Maybe it's a consortium. Maybe it's someone who knows something about future supply constraints that the public won't understand until the shelves are empty. And the scarier possibility is that it's not one buyer at all, but multiple buyers who are all reacting to the same set of signals. Because in markets like this, what you often witness is not one player making a move. You witness a stampede of informed players repositioning before the story becomes mainstream. And that brings us to the next part. The mainstream financial media is whispering about rebalancing and technical flows and normal volatility, as if this is just another season in the markets. But if you've watched this space long enough, you recognize the pattern. When real pressure builds under the surface, headlines get loud about the wrong thing. They'll talk about a chart pattern. They'll talk about a speculative mania. They'll talk about how you should take profits before you lose it all. But they won't talk about the one metric that matters. Who is removing the metal? Because that conversation leads straight into the uncomfortable question. What happens if the exchange can't meet delivery demands at the pace the buyers are demanding? Now, I'm not saying the system collapses tomorrow. I'm saying the system becomes vulnerable when it is forced to do the one thing it was designed to minimize, deliver. And to understand why, we need to talk about rehypothecation. Rehypothecation is a fancy word for a simple problem. The same underlying asset gets promised multiple times. Think of it like a parking space that is rented out to 5 different drivers because the landlord assumes most of them won't show up at the same time. It works until it doesn't. In paper markets, the same ounce can be represented by layers of claims. Futures contracts, ETFs, synthetic products, swaps, options. It creates the appearance of abundance. It creates volume, it creates liquidity, it creates fees, and it creates an entire ecosystem where people trade silver without ever touching silver. But the weakness of the system is obvious. If too many people demand the real metal at once, the paper promises get exposed. Now, we also have to talk about industrial giants because the industrial side of silver demand is not a theory. It's not a maybe. It's a real pipeline of usage that keeps expanding. When a company that depends on silver for manufacturing begins securing supply directly from producers, it's not because they want to speculate. It's because they fear supply disruption. And we've already seen the blueprint for how that works. Instead of buying on the open market and hoping the supply is there, major buyers go directly to producers, buy doré or concentrate, and lock it down. They pay up, they secure the feedstock, they send it to their own refining channels, they remove middleman risk. That is not the behavior of a market that thinks silver will be plentiful forever. It is the behavior of a market that thinks the next shortage could be a national problem. Now here's where it gets spicy. When industrial buyers start to panic, they don't buy a little more. They front load, they stockpile. They say, if I need this for the next 5 years, and I'm not sure it will be there, I'd rather hold too much than too little. Because running out of silver isn't like running out of paper clips. It can shut down production lines. It can halt contracts. It can become a reputational disaster. And this is how the battle sets up. On one side, you have industrial demand that is non-negotiable. They need silver to operate. On another side, you have investors who see silver repricing and they want exposure. On another side, you have governments who see silver as strategic and they want supply security. And then finally, you have retail investors who show up last, paying the highest premiums, fighting for scraps. That's not me being dramatic. That's how commodity cycles usually work. The easy supply gets spoken for before the public understands what's happening. And if you want one of the simplest signals that silver is not a normal commodity, it's this. A surprisingly small portion of mined silver comes from primary silver miners. A huge share comes as a byproduct of mining other metals. That matters because byproduct supply doesn't respond quickly to higher silver prices. If silver doubles, copper miners don't instantly double copper production just to get more byproduct silver. The supply curve is rigid, so when demand rises and supply is rigid, the pressure doesn't release gently. It builds, and then it snaps into a new price regime. Now, speaking of price regimes, let's address the elephant in the room. Silver has moved fast. And whenever silver moves fast, people get scared. They start saying, this is a blow-off top, this is a bubble, this can't last. But here's the difference between a bubble and a repricing event. A bubble is driven by pure speculation and collapses when belief collapses. A repricing event happens when the underlying reality changes and the old price no longer matches the new scarcity or demand structure. When you have consistent structural deficits, and you have buyers removing physical supply, and you have policy moves tightening access, that's not a bubble narrative. That's a scarcity narrative. And scarcity narratives have a habit of becoming very real, very fast. Now, I want to pause for a second and give a creative shout out because some of you asked me to highlight another place where you can see real detailed silver success stories. If you want to watch how regular people have built wealth with silver over time, there's a separate channel linked in the description. Go subscribe to that as well and study the playbook because it's one thing to hear theory and another thing to see real-world execution. All right, back to the main story. One of the biggest mistakes small investors make is they focus on price action and ignore ownership behavior. Price is the public scoreboard. Ownership is the private strategy. And right now, ownership behavior is screaming because if the biggest money in the world is moving billions into physical acquisition month after month, you have to ask yourself, what do they know that you don't? They might know about future demand. They might know about future supply disruptions. They might know about policy changes. They might know about refining bottlenecks. They might know about hidden short exposure that can't be managed if delivery pressure continues. They might know that the paper silver market is far more fragile than people assume. Or they might simply know that in a world where currencies lose purchasing power, hard assets are the lifeboats. And that takes us to the part of this story that connects silver to everything else, the dollar. People love to say the dollar is strong because of the dollar index. But that's like saying a person is healthy because they're taller than the sickest people in the room. The dollar index measures the dollar against other fiat currencies that are also being devalued. It's not a true yardstick of purchasing power. A better measurement is, what can your dollars buy? And when you measure dollars against gold and silver, the story is different. Because what has happened over the last couple decades is that assets priced in dollars look like they're going up. But assets priced in gold often look like they're coming down. That sounds crazy until you do the math. Let's use a simple example. 20 years ago, the average house price in the US was in the low 200s. Gold was in the mid 400s. In that world, it took a little over 500 ounces of gold to buy an average house. Fast forward to today, and yes, house prices are much higher in dollar terms, but gold is also dramatically higher. And when you compute the purchasing power, those same ounces of gold can buy multiple houses today, not one. Which means the house price didn't go up as much as the currency fell. This is the part most people struggle to accept. The currency is the thing that is changing. The unit of account is the thing that is melting. So when you hear silver is going up, a smarter framing is often the dollar is going down and silver is showing you the truth. And that matters, because if the system is built on perpetual currency dilution, then hard assets don't need to win. They just need to remain hard while the money remains soft. Now I can already hear someone saying, okay, but what does that mean for me? Here's what it means. If you're a small silver investor, you can't outbid governments. You can't outmuscle industrial giants. You can't outleverage hedge funds. But you can pay attention early. You can understand the difference between paper narratives and physical signals. You can stop letting mainstream headlines scare you out of positions at the exact moments when physical accumulation is accelerating. You can think like a risk manager, not like a gambler. And you can avoid the trap that kills most people, waiting for confirmation from the same outlets that ignored the signals. Because once the mainstream starts screaming about silver, it won't be because it's safe. It will be because it's obvious. And when it becomes obvious, it becomes expensive. Now, let me add something here that matters for this community. If you've had success in your life or your investments, share a quick win in the comments. It doesn't have to be a flex, just a real story, because when people see others building, learning, and improving, it lifts the whole community. And while you're down there, I've got a question for you. Do you think the biggest silver buyer right now is a government, an industrial company, or a financial institution? Here's a second question. If you woke up tomorrow and saw a headline that said delivery delays or cash settlement incentives, would you be surprised, or do you think the system is already heading there? Now, I need to keep this practical. So let's talk about the mechanics of why deliveries matter so much. When a lot of contracts stand for delivery, it forces the exchange's inventory system to perform under pressure. It forces movement between registered and eligible categories. It forces allocation. It forces bars to be located, transferred, verified, and none of that is impossible. But at scale, it becomes sensitive, because the moment any part of that chain slows, rumors spread. And when rumors spread in a commodity market, people don't wait for the official press release. They act. That's why physical delivery pressure can be self-reinforcing. More deliveries lead to more attention. More attention leads to more deliveries. And at some point, the paper market can't suppress the signal with headlines. Now, I want to be clear. The goal here is not fear. The goal is awareness. Silver is not a get-rich-quick ticket. Silver is a strategic asset that sits at the intersection of money, industry, and security. That plurality is rare. Most commodities are industrial only. Some assets are monetary only. Silver is both. Plus, it has military applications that never show up in polite conversations. So when you see a multi-year structural deficit, and you see acceleration in delivery, and you see policy shifts, you don't need to panic. You need to pay attention, because this is exactly how long-term repricing stories begin quietly and then suddenly. Now, let's talk about one more aspect that can't be ignored: the positioning of banks. In markets like this, short exposure is the silent killer. If large players are naked short, they are effectively betting they can source metal cheaply later, or that they can settle in cash, or that nobody will demand delivery at scale. But when delivery demand spikes, the shorts lose control of the timeline. And timeline risk is brutal, because a short can survive price moves if they have time to manage it. But a short can die if they are forced to deliver something they can't source quickly. This is where you start hearing whispers that some banks flipped positions, that the exposure moved, that certain regions are more vulnerable than others. I'm not here to name names from someone else's script. I'm here to explain the dynamic. When the smart money changes sides, it's usually because the risk has become asymmetric. And in silver, asymmetry is the whole story. Your downside is limited by real-world industrial demand and scarcity. Your upside is amplified by the paper structure and the potential for a scramble. That's why you see periods where silver does nothing for a while and then moves in violent steps. It's not a smooth asset. It's a pressure cooker. Now, at this point, some of you are thinking, okay, but I'm just one person. What can I do? You can do three things. First, educate yourself on the signals that matter: delivery, policy, supply deficits, industrial procurement, refining concentration. Second, build your plan around risk management, position sizing, time horizon, and emotional control. Third, stay connected so you don't miss the fast moves when they happen. And that's why I'm mentioning again, the WhatsApp channel link is in the description. If you want instant updates and voice notes when things break, join it. It's one of the best ways to stay ahead of the lag. Now, I also need to mention something important for the people who are actually following closely. By the time you're watching this, I will have already published a members-only video that bundles the latest updates and a deeper analysis in one place. If you want the premium breakdowns and you want to prove you're really following, consider joining the membership. Members get the in-depth context and fewer filters. All right, let's bring it back to the core story and connect the final dots. The world is moving toward a reality where supply chains are being nationalized, prioritized, and controlled. We see it in energy. We see it in food. We see it in chips. And we are seeing it in strategic minerals. Silver fits directly into that trend. When nations prioritize domestic needs, exports tighten. When exports tighten, global availability shrinks. When global availability shrinks, industrial buyers pre-buy. When industrial buyers pre-buy, inventories drain. When inventories drain, delivery requests rise. When delivery requests rise, paper markets get stressed. When paper markets get stressed, price discovery shifts. And when price discovery shifts, the public suddenly becomes interested. This is the sequence. It's not a prediction. It's a pattern that is repeated in different forms across different commodities. Now, does that mean silver goes straight up forever? No, it means silver becomes more strategic, more contested, and more prone to rapid repricing episodes. And in that kind of environment, small investors need to stop thinking like day traders and start thinking like planners. Because the people who win these cycles are not the ones who perfectly time every move. They are the ones who understand the story early and manage their exposure intelligently. Now, let's talk about the ratio conversation, because it's one of the simplest ways to see the distortion. Silver is mined at a much smaller ratio to gold than it is priced. That alone should make you pause. Then you add the fact that silver gets consumed and not recycled at high rates because it's used in tiny amounts in millions of devices. Gold mostly sits, silver disappears. That changes the supply picture over decades. So if the market begins to regress toward historical ratios, or even toward more reasonable ratios, it implies that silver has a lot of room to move relative to gold. And the move doesn't need to be perfectly logical in the short term. It just needs to reflect the growing scarcity and the growing strategic demand. Now, I'm going to say something that might sound like a cliffhanger, but I mean it literally. The biggest risk for the paper silver market is not price, it's delivery. Price can be managed with narratives, leverage, and liquidity games. Delivery forces reality, and reality is hard to negotiate with. So here's what I want you to do. Watch the delivery numbers. Watch whether these minor months stay abnormal. Watch whether industrial procurement continues directly from producers. Watch whether policy language tightens around critical materials. Watch whether premiums in the physical market stay elevated. And watch whether the mainstream starts discovering silver after it has already moved. Because when they discover it, it won't be for your benefit. It will be because the story is no longer containable. Now, before we wrap up, I want to make this engaging and useful for the community. If you've been stacking or investing for a while, share the moment that made you take silver seriously. Whether it was inflation, supply chains, geopolitics, or something personal. And if you're newer, drop your biggest challenge in the comments, whether it's price, storage, premiums, or timing, and I'll pull viewer points for future videos the way we build this channel together. Finally, here's the short CTA because I'm not going to drag it out. Subscribe to the channel so you don't miss the next update. And hit the like if you want me to keep covering the delivery data and the behind-the-scenes signals. And remember, if you value original work and you want to help me push back against the copycats, comment, "OG, it matters more than you think." Now, let me slow this down and walk you through the plumbing, because this is where most people get lost and then fall back into emotional decisions. On the exchange, inventory isn't just one pile. There's the metal that's effectively ready to deliver. And there's metal that's stored, but not committed, unless an owner chooses to make it available. Think of it like a store shelf versus a warehouse. When delivery requests surge, the shelf empties first. Then the market has to coax metal from the warehouse to the shelf. And that's where stress starts. Not because silver doesn't exist somewhere, but because deliverable silver at a specific place on a specific timeline is a different question. That's the timing problem. And timing problems are what break paper systems. Because paper systems are built on confidence that settlement will occur smoothly. They can look fine for years and then wobble in a single week if too many participants demand the underlying asset at the same time. That's why delivery pressure matters more than price action. Price can be pushed around with leverage headlines and risk on risk-off narratives. Delivery forces reality. Now here's a cliffhanger you should sit with. What if these buyers aren't chasing profit, but chasing insurance? If a buyer's goal is insurance, a $5 dip doesn't scare them, it motivates them. They don't care about next Friday's candle. They care about securing metal before access tightens. And that's exactly what strategic behavior looks like. Persistent calendar agnostic accumulation. Which brings us back to deficits. A structural deficit means the world is consuming more silver than it produces year after year. That can be masked for a long time by above-ground inventory, but every year of deficit quietly drains the cushion. The thinner that cushion gets, the more sensitive the market becomes to shocks, a mine disruption, a refinery bottleneck, a policy change, a surge in industrial demand. And silver is uniquely vulnerable here because so much of its supply is byproduct supply. If base metal mining slows, silver output can fall even if silver demand rises. That's the kind of feedback loop that turns tight into scarce without warning. Now, if you want a street-level truth signal that doesn't require a terminal, pay attention to physical availability and premiums. Paper price can look calm while the real market is straining because premiums reflect replacement cost and supply tightness in the real world. And this is why the critical material language matters so much. Once a commodity becomes strategic, it stops being treated like a normal commodity. Countries don't just buy it, they protect it. They prioritize domestic needs, they tighten exports, they shift from sell to the world to secure for ourselves. That's not a conspiracy. That's what nations do when something becomes essential to security and industry. Now, I also want to say this clearly. Retail is almost always last. Not because retail is dumb, but because retail gets fed the story late. Retail gets trained by headlines. When price rises, they get told it's too late. When price drops, they get told it's going to zero. And when the real signals show up, they get distracted with noise. If you want to break that cycle, follow flows, not feelings. Deliveries are flow. Direct mine sourcing is flow. Export tightening is flow. And the flow right now is pointing in one direction, physical control. Now, about the battle scenario, because this is where things can get violent. Industrial buyers can delay purchases for a bit, but they can't stop needing silver. They can't redesign the global electronics and energy stack overnight. So when industrial procurement collides with persistent investment demand, you don't get a polite market. You get a bidding war. And bidding wars don't care about anyone's comfort zone. They care about clearing price. Picture it like this. One major manufacturer decides to secure a year of feedstock just in case. That drains supply. Another manufacturer notices and does the same. Then the sector starts front-running the future because nobody wants to be the last buyer in a tight market. At the same time, funds chase performance and then retail piles in when the story finally becomes obvious. That sequence doesn't end with gentle corrections. It ends with repricing. Now, I'm not asking you to predict the exact day. I'm asking you to recognize the direction of pressure. And the pressure is moving toward ownership, security, and removal of counterparty risk. That's why the biggest players are not just trading the story, they're taking the metal. Now, quick reminder as we close in, if you've learned something from these videos, share a small success story in the comments. It lifts the community and it helps me understand what's actually working for you. And I've got one more engagement prompt for you in the comments. Pick what you believe the next big catalyst will be. Industrial supply panic, a policy restriction, or a paper market delivery squeeze. And share the signal you're watching. Because the silver market isn't just moving, it's being restructured. First comes the quiet accumulation, then comes the visible strain, then comes the public stampede, and then comes the regret of everyone who waited for confirmation. And here's the near-term trigger that I'm watching like a hawk. We're still early in this delivery window. There's time left for more contracts to stand. And that matters because the market usually cools off after the first rush. If the pace stays elevated instead of fading, it tells you this is not a one-off event. It's a movement. Watch how quickly deliverable inventory refills after large stops. If it refills instantly, the system is comfortable. If it refills slowly, the system is negotiating. And if you start seeing unusual incentives, unusual spreads, or chatter about alternative settlement, that's the market admitting stress without using the word stress. Also, watch what happens when the next major month approaches. Big players often position early, and if they're willing to pull metal in smaller months, imagine what they'll do when the calendar gives them the bigger stage. This is why I keep telling you, don't get hypnotized by a single red day or green day. In a repricing story, volatility is the tax you pay for being early. And yes, I know some of you want the perfect entry, but perfection is usually a disguise for procrastination. The better approach is a plan. Scale in, manage your exposure, and keep dry powder so you're not forced to sell when the crowd gets scared. One more thing before we land the plane. The members-only video I mentioned earlier ties all of these signals together with additional charts, delivery updates, and a deeper breakdown of what I'm watching next. If you want the condensed everything in one place version, that's where it is. And if you're serious about staying ahead, join the WhatsApp channel as well. I'll post fast updates there when new delivery data drops, and I'll tell you what matters and what doesn't.